Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. My name is Robert Kuhn. You're listening to Destination Retirement. Thank you for joining us for the last show of the year. It's been a great year. I want to thank everybody for listening and continue to see the podcast numbers, which if you don't know, we do podcast every episode of this radio show. So you can catch it at maybe a more convenient time than listening to the show live. But we do keep seeing the numbers go up and to the right, and we really want to double and triple those numbers for 2024. So thank you. Hopefully everybody had a great Christmas, Happy New Year, and just a phenomenal holiday. We're going to make this last show very productive, and that is ultimately my goal of every show, but we're certainly going to talk a lot about tax reduction and just other topics I think that you need to be aware of going into the new year. So if you haven't listened before, welcome. If you're a repeat listener, thank you. My name again is Robert Kuhn. This is Destination Retirement. I'm also the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm, and yes, we are a fiduciary. Everything that we do, we believe it's absolutely unique. We see far too many generic portfolios. Again, whether you have $100,000 or $15 to $20 million to invest, you need customization, especially when it comes to tax planning and tax reduction. So we're going to talk a lot about that today, but our job as an advisory firm is to make sure that we construct a portfolio that can do well whether the markets are up, whether the markets are down, or whether the markets are sideways. Most portfolios that we meet with, or most listeners that call in that we meet with, they're certainly going to do well in an up market. They're going to lose money in a down market, and in a sideways market, who knows? So we think most advisory firms are failing clients because if you want to make money when the markets go up, lose money when the markets go down, and then in a sideways market, just, have some uncertainty, well, you can do that on your own. Don't pay an advisory fee to just track the market up and down. So with that being said, if you have any questions relating to your investment portfolio, your 401k, just give Paige a call, 630-492-1912. 630-492-1912. If you've listened to the show, we talk about a lot about tax reduction, tax strategies that can significantly reduce your taxable income and still pay strong distributions independent of the stock and bond market. And it's something that is a major focus of ours going into 2024. If you sold a business, if you're a high wage earner, if you sold property, if you have concentrated stock positions, if you want to tax efficiently take distributions from your IRA, then we're going to be a group that you want to talk with. If you're working with a bank, or if you're working with a big nationally known brokerage firm, they have almost no cutting edge strategies when it comes to tax reduction. They just don't exist. Maybe they exist for their ultra high net worth clients, but they don't offer them to the masses. And so it's a focus of ours this year, to the tune of, if you'd like to reduce your taxable income by $75,000 to $80,000 per $100,000 invested, those strategies exist. Now, I want to preface this by saying I'm not a tax advisor. These tax benefits, however, are very straightforward, but we always recommend that you talk with your tax advisor before you make any investment whatsoever that has tax benefits. But in the energy space, you can greatly reduce your taxable income. And when we look at strategies that are absolutely cutting edge and strategies that pay strong distributions, that have a very very, very strong return profile. And then you can tack on top of that the tax benefits. Again, reduce your taxable income by $75,000 to $80,000 per $100,000 invested. These are strategies that you just need to hear of and hear about. And you need to hear the pros, you need to hear the cons. You have to get educated because if there's a lot of people that have large capital gains, or people who have, pay significant, ordinary income. And our job is to reduce that. And when you look at the most overlooked area of financial planning, it certainly is tax planning and tax reduction, because tax reduction starts January 1st. It's not something you wait till the end of the year. It's not something you worry about in April. It's something that you have to plan for. And so strategies exist, again, that can reduce your taxable income greatly. So we like to say it's a 5 to 20% holding generally. It's a very institutional type strategy. So it's certainly, it's very basic actually, but it certainly, may take you some education to get fully up to speed on what it is and what it's not. And our job is to identify those individuals who could benefit from reducing your taxable income. So if that's you, again, huge focus of ours in 2024, just give us a call. Let's have that tax strategy conversation. 630-492-1912, 630-492-1912. And we can certainly, Paige will set some time up for us to have a conversation of how we can try and reduce your taxable income or reduce capital gains. In the energy space, it's obviously tax benefits are huge in the energy space. But also, the distributions can be significant and they're not dependent upon the stock and bond market. So we're going into a period of time, possibly in 2024. Again, opinions are just what they are. Everybody has one, right? We've all heard that saying before. But we are seeing, many strategists, talk about 10, 15, 20, 30% correction. And that's okay if you're positioned correctly. It's opportunity if you're positioned correctly. And so that's our job, is to make sure that we are positioning client portfolios to take advantage of whatever the markets throw our way. So again, you're working with a good advisory firm if you have an advisor that talks about strategies that will do well when the markets don't do well, strategies that can make money when the markets are negative, and those strategies exist. Again, some are good, some are bad. I mean, I'm not, making a call on whether the strategy is good or bad, but strategies exist where we could greatly reduce your taxable income. Strategies exist where you can have positive returns when the markets are negative. And then strategies exist that you can take advantage of market volatility. We just see far too many cookie cutter generic portfolios, advisors that have clients that simply, have a great year this year because the markets did phenomenal, right? I mean, everybody thinks they're working with a genius if the markets are up this year. Well, here's the challenge. What if the markets are down 15 to 20% next year? How are you going to keep those gains? Are you going to just simply ride the roller coaster up and ride the roller coaster down? So that's our job, is to make sure that we're bringing those strategies to you. They will be new to you. So our job at the heart of everything we do is education. So 630-492-1912. Okay, I saw a great quote this past week, and I want to spend some time on it because I think it hit the nail right on the head of what is wrong with Wall Street. And the quote was, "Complexity is not always negative." Think about that. Complexity is not always negative. I personally disagree with oversimplifying everything just for the mass adoption, and that is what Wall Street is. Wall Street wants to simplify everything for mass adoption. If more people adopt it, if more people can just basically wrap their head around it and fully understand it, well, then they're going to, assets are going to flood to it. And generally what I have found is the more basic an investment, the greater likelihood that you're just going to track the market up and track the market down. And again, that should not be good enough for you. So complexity is not always a negative. I mean, what is complex to you generally is, after 26 years in the investment advice business, it generally becomes very simplistic to me. The challenge that I have is taking a complex topic and making sure that you can at least understand it so you can make a decision that is going to be good for you and your family when it comes to your investing portfolio. Let's take, the equity markets, for example. Wall Street wants you to buy and hold. Advisors want you to buy and hold. And we're not against buy and hold. There's a time that you have to buy and hold, but there's also a time that you have to have active management. Wall Street wants you to buy and hold. The advisor wants you to buy and hold so they can be out finding new assets, so they can increase their income, their revenue on an annual basis. And the challenge with that is really, where are you at in your life cycle, your investing life cycle? Are you retired? Are you 5 years from retirement? Are you 10 years from retirement? Buy and hold could be the worst thing that you could possibly do. Again, that doesn't mean we want active management for active management's sake. That doesn't mean that we're trying to outsmart the market, that we're trying to predict the market, that we're trying to look into our crystal ball and see where the market is going to go tomorrow. It's not that in any way, shape, or form. But when you look at how advisors manage their personal money, and you look at the firms and how they manage the Wall Street manages the firm's money, I promise you it's not buy and hold. It's never just buy and wish or buy and hope or whatever the analogy is. But yet when it comes to recommending to clients, well, they just want you to think that that's the only strategy. And so it goes back to complexity, right? Our asset managers that we utilize, they have a very, very complex algorithm, a very complex mathematical model. And it is, again, it's not predicting. It's just playing offense and defense. And if you deem active management at getting out at the top and back in at the bottom, well, then of course you're just setting yourself up for probably failure, and your expectations aren't, just probably not realistic. But active management isn't trying to time the market. Active management is recognizing that there are times that we have to play defense, keep those gains. I mean, goodness. Isn't that how ultimately you beat the market over time? Isn't that how you grow wealth, is to minimize losses? So yeah, if you look at our mathematical manager or model that we use, which is a manager you can't get directly, that you have to work with a select group, and we're part of that select group that has the ability to offer this manager. Yes, it's a very complex model, 50,000 lines of code. That sounds great, right? Well, it's just very mathematical. You're letting the computers do what the computers do. And to be able to get that type of money management for a 401k, if you have a 401k, and if you're with Fidelity, if you're with Charles Schwab, if you're with Empower, there's probably a good chance that we can add that to your plan. And again, doesn't leave the plan, but you can add that type of a money management style that you can now have your 401k managed in the most cutting edge way. If you certainly have investments that are outside of an IRA or 401k, most listeners do, you have a couple options. Just track the market up, track the market down. And, this year is fantastic. And then next year, what if we're down 20% or 30% and you give back those gains? Well, what if you had a strategy that did play defense and whose goal was to keep those gains and then shelter those gains from potential, market shocks. And then not only that, but actually be able to take advantage of the downside, take advantage of buying things that are on sale. Cash is king in so many ways. But yet when it comes to Wall Street, they just don't talk about cash because most advisors don't get paid when you let your money sit in cash. And that's just unfortunate. So again, complexity is not always negative. Complexity is very, very positive. We're going to talk about complexity when it comes to tax strategies. We're going to talk about complexity when it comes to principal protection. And we're going to talk about complexity when it comes to income strategies when we get back. So if you want to reduce your taxable income, if you sold a building, sold a business, if you're a high wage earner, and you'd like to reduce your taxable income, if you have concentrated stock positions, or if you just want to, again, reduce your taxable income, then please reach out to us. Again, our strategies can reduce taxable income by $75,000 to $80,000 per $100,000 invested. Strong distributions, a great return profile. Let's have that conversation. So 630-492-1912, 630-492-1912. When we come back, we're going to talk about complexity and taxes, income strategies, and principal protection strategies. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Back, you're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, host of this radio show. We're a fiduciary, we're independent, we're a registered investment advisory firm. Our goal is to create portfolios that have characteristics of investments that can do well, whether the markets are up, down, or sideways. Most people listening, it doesn't matter how much money you have, whether you have $100,000 or $15 to $20 million with your advisor, you're going to do very well when the markets are up. You're going to lose money when the markets are down. And then in a sideways market, it's anybody's guess. So our job is to educate you that if that's the type of money management that you want, then save the fee that you're paying us. Save the fee that you're paying the advisor. You can do that on your own. You must work with, especially in this market, an advisory firm that has strategies that'll do well when the markets are up, strategies that'll do well when the markets are down, and then strategies that can perform in a sideways market. So with that being said, if you've listened to the radio show, hopefully everybody had a great year this year, but that doesn't mean that next year is going to be a good year for your portfolio. The challenge is, what if the markets drop 15, 20, or 30% like many are saying? Again, it's an opinion. Opinions are right and opinions are wrong. So who knows what's going to happen in the market? I can see a case for the markets to continue with this unprecedented run up, and I can see a case for the market to go down. And that is why we don't want to guess. We don't want to predict. We don't want to look at our crystal ball. Portfolio construction, investment success starts with crafting a portfolio that can do well when the markets are up or down. Strategies that can actually preserve principal when the markets are down, and strategies that can actually have positive returns when the markets are down. It's just something that we have to do. Again, complexity. Complexity is not always a negative. I disagree with oversimplifying things just for mass adoption. And there's nothing, especially when it comes to Wall Street. And that's what their job is to do. A lot of the strategies that we talk about, individuals are going to say, I've never heard of that before. Well, it's actually very basic. It's just your advisor doesn't want to provide you strategies that can do well when the markets are down or whether the markets are sideways. So that's our job. So give Paige a call, 630-492-1912, 630-492-1912. Let's have that conversation. So let's talk about complexity and taxes. Okay. Really simple. If you're working with a big bank or a big brokerage firm, probably the most cutting edge strategy that you have when it comes to tax planning are trying to match portfolio gains with portfolio losses to minimize your capital gains. That's it. That is not cutting edge tax strategies. We are talking about strategies that can reduce your taxable income by $75,000 to $80,000 per $100,000 invested. Again, I want to make sure that you know that we don't provide tax advice. Although these tax strategies are very simplistic, we do recommend always talking with a tax professional. So I want to get that out of the way. But in the energy space, there are investments that you can greatly reduce your taxable income. And here's the beauty. They're not the returns, the distributions, they're not tied to the overall stock and bond market. So we want to make sure that if you've sold a building, if you've sold a business, if you're a high wage earner, if you're a high 1099 wage earner, or if you're a high W-2 wage earner, or if you have concentrated stock positions, that you reach out and we have a conversation of how we can reduce your taxable income. Generally, you're looking at $75,000 to $80,000 per $100,000 invested. That's kind of just where we start. And then when you look at the return characteristics in the energy space, generally you're looking at 9 to 13 to 14% distributions annually, and that's certainly can be higher, but we like to err on the side of just what we think the targets can be hit conservatively. And then you're looking at a return profile somewhere in the neighborhood of 1.3 to 1.6, 1.7% over a kind of a 1 to 2 to 3 year period. So tax benefits on top of strong distributions with a very above average return profile going into a market period where we may see significant volatility. It could be the best 5 to 10 to 15% allocation of your portfolio. So let's have that conversation. 630-492-1912. Okay, complexity on strategies that can make money when the markets are down. Very, very basic strategies. The private banks offer these strategies. We've been utilizing these strategies for really the better part of 15 to 20 years. The challenge was really the barrier of entry. You used to have significant money, generally 7 figures as an initial investment. Today, that's come down all the way to $1,000, and you heard that correctly, $1,000. So this is not just for the mass affluent or the core affluent or the ultra high net worth. This is now for everybody, and these strategies are generally 12 to 15 months in duration. They're offered by the largest banks, so we generally tend to look at the ones offered by JP Morgan because you're buying the credit of the bank. So you want to make sure that it's a very strong credit company, and it's very, very simple. Again, if you've listened to the show, you've heard the dual directional notes ad nauseum. You've heard us talk about it over and over again, and there's a reason why. Because so many individuals lost money over the last 2 to 3 years in their fixed income holdings. And what has happened was Wall Street, the advisors, they've told you that you have to be conservative, you have to have a balanced portfolio, so you have to have fixed income. Well, how'd that do for you over the last few years? And I have news for you. It was so telegraphed that the Fed was going to raise rates. Everybody knew that was ultimately going to happen, right? Now it happened, faster than most people thought. So, we will give advisors, that bogey because, they certainly did go up much faster than we thought. However, I've seen more and more people lose 10%, 15%, 30% on their safe money. So last year, 2022, not only did many people lose money when the markets were down, but they also lost money with their safe money. So you have to, again, an advisor, that's just not good enough. So the dual directional notes are a phenomenal hedge to the equity markets. They're a phenomenal benefit to a fixed income replacement, and they're very simple. You have a maximum cap on the upside. You make money to a point on the downside. That is exactly what it is. So let me give you an example. S&P 500. So we did a 15-month dual directional S&P 500 note. Let's say JP Morgan was the bank. So you're buying JP Morgan. Everybody knows JP Morgan. I think JP Morgan's going to be here in 15 months, so I'm very comfortable with the credit profile. Let's say your max gain was 20% on the S&P 500. So you got the first 20% of the S&P 500 in 15 months. So if you bought it today, they look at the S&P in 15 months, and from 0 to 20%, you got 100% of that return. Let's say the S&P was up 25. Well, your maximum gain was 20. So 0 to 20 on the up. Here's the benefit. There's an absolute return buffer, and all that is a fancy way of saying you can make money when the markets are negative. Generally, we're going to use the 20% downside buffer. So that means from 0 to negative 20%, your return is going to be the inverse of the negative return. So in 15 months, say the S&P was down 20%. Well, your return during that time period is 20% to the positive. So you heard that right. You had 20% protection to make money. So if the S&P was down 5, you were positive 5. If it was down 10, you were positive 10. If it was down 15, you were positive 15. If it was down 20, you were positive 20. So yes, cap on the upside, generally in the neighborhood of 18 to 23%, just depending upon where they are at the time that we do the notes. You're going to make money at a cap on the upside, still make money when the markets are down. That is huge. Generally, we're going to do the negative 20% buffer. So most people will ask, well, what happens if the S&P is down more than 20%? Great question. Look at negative 20 as your zero. So if the S&P was down 21, you were only down 1. If it was down 22, you were down 2. So great return profile on the upside. Still make money on when the markets are down to a point, and then you have a big buffer if we see a big market crash. Again, that's a relatively simplistic investment. The complexity may come for, conceptually, how do you get your mind around, well, how in the world can they do that? Well, it's just options. It's derivatives. I mean, they can buy protection for 16ths of a cent where it may cost us $1. I mean, so it's just the power of a big balance sheet. And again, complexity is not negative. Complexity is, generally speaking, is going to be a good thing for the investor. So when it comes to strategies that can do well when the markets don't do well, that's one of them, the dual directional notes. Another strategy, which is we think very, very basic, are these principal protection strategies. They exist. Again, some are good, some are bad. But if you're willing to take a upside cap of, say, 10 to 14% on the S&P on an annual basis, and any gain you get in a year is locked in. Okay, so locked in for the life of the investment. So you're not having to play that catch-up game. So if you put in $100,000 and it went up to $110,000 in the first year, that gain's locked in. And then in year 2, if the markets drop, well, you don't go down. Then year 3, if there's a gain in the market, well, they go on top of the previous gain, and it's 100% principal protected, where your worst year is 0. Those strategies exist. Again, complexity is not always a negative thing. These are very basic investments. They're very easily understood if you have an advisor that can share with you the pros and cons of every investment. It doesn't matter what it is. There's a positive and a negative. So if you want principal protection, if you want strategies that you can make money to a point when the markets are down, we just have to have a conversation. 630-492-1912. 630-492-1912. So far today, we've talked about ways to reduce your taxable income. That's a huge focus of ours because, in my opinion, it's the most overlooked area when it comes to financial planning. Tax reduction. I'm not talking about matching gains with losses, winners with losers. That is just too basic. We're talking about ways to reduce your taxable income by $75,000 to $80,000 per $100,000 invested. If that's something that you want to talk about, well, let's have that conversation. We've talked about ways to make money when the markets are negative. Those, again, are strategies that we just have to talk about. It's a real simple hedge. Most people hedge every area of their life with some sort of car insurance, homeowners insurance, life insurance, etc., health insurance. But when it comes to their investment portfolio, they're just riding in a car without an airbag. They're out in the water without life vests. It's just you're at the mercy of the market, and that is not good enough. If you're willing to learn some very basic ways that the big banks can hedge investments in ways that you can't, I think you're going to have a very, very beneficial 2024. I think you're going to grow your portfolio in a way that you just won't if you just simply ride the market up and down. So again, $100,000 or $20 million to invest, it doesn't matter to us. Our criteria to working with somebody is, can we help you? Number 2, are you receptive to that help? We don't just want to do more of the same. That's not who we are. So give us a call. Paige will set some time up for us to have a conversation. 630-492-1912. 630-492-1912. Again, complexity is not always a negative. We're going to talk about complexity when it comes to income planning after the break. So 630-492-1912. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus Must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. I am the host of this radio show, Robert Kuhn. I am also the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Our job is to make sure when we construct portfolios for our clients that we have investments that have characteristics to be able to deliver positive returns, whether the markets are up, down, or sideways. That is a huge differentiation of what it is that we do versus what it is that the average person is doing. Again, our job when we construct portfolios is to always include strategies that can do well, whether the markets are up, down, or sideways. So with that being said, we've talked a lot about tax reduction. If you'd like to reduce your taxable income, if you sold a building, if you sold a business, if you're a high wage earner, whether it's W-2 or 1099, and you could benefit from reducing your taxable income, tax planning is a year-round activity. We can, strategies do exist in the energy space that pay strong distributions, that have strong return characteristic profiles, and can reduce your taxable income by up to $75,000 to $80,000 per $100,000 invested. So again, huge push for us this year in 2024 to make sure that we're bringing these strategies to the masses. Again, complexity is not always a negative. We disagree with oversimplifying things just for mass adoption, especially when it comes to investment planning. That is always what we see. You just don't see, strategies that, because the strategies we talk about that do well when the markets don't do well, or strategies that can greatly reduce your taxable income. They're very, very basic. I mean, very, very basic strategies. They're just not mass marketed. You don't see advertising. You don't see Wall Street just, trying to create mass adoption because they're complex. And again, simplistic to us, but complex to you. But our job is to make sure that we're providing the education so you can make a decision on, what's best for you and your family and how to create long-term wealth. And again, $100,000 or $100 million, wealth is individualized. When we say wealth, everybody has a number of what we think is rich or what we think is wealthy. It doesn't matter to us. Whatever you have, you are wealthy. And we take that very, very seriously. So with that being said, give Paige a call, 630-492-1912, 630-492-1912. Okay, let's talk about income planning. So income planning is, it's like a black box when it comes to investing. We think you need to have an income plan. We think that income plan needs to be written. We think that you have to have an income maximization plan, a tax reduction plan. It's unfortunately, most advisors are not articulating to clients exactly what has to happen inside of a portfolio, whether it goes up or down, for them to take either more income or less income. And most advisors are still using kind of a pass-fail, Monte Carlo strategy, and that's really just not good enough. It's good, but it's not good enough. Because when you have a probability analysis of, say, 90%, so they just take your resources, they take your income, they take your age, they look at inflation, they look at assumed market growth. And yes, the report is impressive, but I could have an income plan like that run in 2 seconds. And then it'll give you a probability of success. And let's say that probability is 90% or 87 or 85 or whatever that number is. Well, you have to look at the other side of the equation. Well, that means 10% of the time I'm going to fail, or 15% of the time I'm going to fail. And what strategies do I have in place that can protect that from happening? And so when we look at what's wrong with the financial advice business, it's not being proactive when it comes to tax strategies. We've talked a lot about that today. It's not being proactive on strategies that can do well when the markets don't do well. We talked a lot about that today. And then it's, when it comes to income planning, it's just very, very basic. I mean, it's dollar cost averaging in reverse. And that's just not good enough, especially in this market. Look at what most fixed income has done over the last 2 to 3 years. In a lot of instances, it's down 10 to 15 to 30%. And it's just things that we have to have this conversation. We have to talk about, because if we look at, the most efficient way to generate income, again, what I have found is if you have $1 million or under, you're laser of investable assets, you're laser focused on income planning. You're laser focused on making sure that you have enough cash flow over a 20 to 30 year retirement in a period of significant inflation, that you have the income that's going to cover your necessities, your needs, and then hopefully it can cover your wants, right? So I commend those individuals. Again, what I have generally seen, over 26 years is kind of that $1 million number, $1 million and under, or right around $1 million. You're very, very focused on income planning, and you're very receptive to strategies that can provide guaranteed income, because those strategies exist. And how great is that to know that you have a bucket of your money that if you have 3 to 5 to 7 to 10 years to plan for, that you can create a strategy that can provide, in many instances, distribution yields that are guaranteed for life, that you just simply can't replicate. 7%, 9%, 10% distribution yields that you're guaranteed for life. Again, there's a pro and a con to everything, but if we don't have to outlay a significant bucket or a percentage of your portfolio to generate cash flow, that just means more growth for you. And, those strategies exist. And what we have found is, those investors that have $1 to $10 million of investable assets, they're generally not concerned about paying the bills. For obvious reasons, but that doesn't mean that we shouldn't maximize your cash flow. Maximize your cash flow. Maximize your after-tax cash flow. It's unfortunate that this industry has done a very good job. Well, I don't know if they've done a very good job, but accumulating your money is generally very easy. Now, we don't think many advisors, do the the right job, because again, you're just riding that Wall Street roller coaster of making money when the markets are up and losing money when the markets are down. But it's not going to hurt you when the markets are down necessarily if you're still working, if you're still contributing to a portfolio, because in theory you're buying things cheaper. And if you have some time, and if you have a period of 3 to 5 to 7 to 10 years, hopefully that money is going to come back. But when you don't have cash to put to work when the markets are down, those losses are magnified. And if you don't have a guaranteed income strategy in place, then all you're doing is taking money out of your portfolio at the wrong time, which, when the markets are down. And so when the markets ultimately recover, whether that's, 1 year, 10 years, whatever that number is, you have less money to recoup because you're pulling that money out. So we need to look at strategies that can greatly enhance your cash flow. Again, it's just, what we find is again, very cookie cutter strategies. And again, I've said it multiple times today, complexity is not negative. I disagree with oversimplifying investments just for mass adoption. It's good for us because if we're charging a fee on your assets, well, obviously our fees go up the more money that we manage, but that doesn't mean that the investment is ultimately good for you. So when it comes to income planning, we have a very unique income planning software that I've yet to see mass adoption on because probably the cost, and advisors, don't want to cover that cost. We do. We believe in it because it's a way that we can show each and every client, whether you have $100,000 or $20 million, exactly what has to happen inside of your portfolio for you to get a raise, or to have to take less if we're going through a period of complex and volatile markets, because that does happen. And again, my favorite statistic, one of them is if you bought Microsoft in 2000, it took you 14 years to get back to even. If you bought Microsoft in 2000, it took you 14 years to get back to even. What happens if we see another market like that? What does that do to ultimately your portfolio? Do you have anything inside of your portfolio that would have positive returns in negative markets? And if you don't, we have to have that conversation. 630-492-1912, 630-492-1912. So we've gone through so much this last episode of the year. We want to make 2024 a great year for every investor, regardless if the markets go down significantly, which many people are calling for. Again, that's just one opinion, and my opinion may differ from that. And but again, our job is to make sure that if we do see a negative market, that we have investments that will make money. That is the job of an advisor. So give Paige a call. Let's set that conversation up this week, 630-492-1912, 630-492-1912. If you'd like to learn about our tax reduction strategies that we are going to be laser focused on in 2024, it's because of the market. I think we're going to be in a low return market, and investments in the energy space can pay significant distributions that are not dependent upon the stock and bond market. The return characteristics are, in my opinion, above average. And then when we can reduce your taxable income by $75,000 to $80,000 per $100,000 invested, it's probably something that you may want to learn about. You may want to consider allocating 5 to 15% of your portfolio to a strategy like that. If you're taking distributions from an IRA, let us show you how we can reduce that tax that's going to be due, because all distributions from IRAs are taxed as ordinary income. So if you do take money from your IRA, let's talk about strategies that we can greatly reduce that tax due by reducing that income. So 630-492-1912, 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are fiduciary. We focus on strategies that can greatly reduce your taxable income, strategies that have characteristics that can do well whether the markets are up, down, or sideways. And I think that's the job of an advisor. That's the job of anybody that you are going to pay to manage money. I think you have to look at what are they doing that I can't do on my own. And that, to me, is a big key to knowing that you're working with a good advisory firm, is that they talk about strategies that can generate positive rates of return when the markets are negative. Let's face it, everybody's a genius when the markets go up, right? It's not hard to make money this year. This year, the markets did what they did, right? And most people are going to make money when the markets go up. So why not focus on strategies that can do well when the markets don't do well? strategies that can actually deliver positive returns when the markets are negative, strategies that can generate significant tax reduction. I can't tell you how many people that we are going to talk about this with in 2024. It's going to be significant. If you sold a building, if you sold a business, if you're a high wage earner, whether it's 1099 or W-2, if you have significant capital gains, let's talk about a strategy that can greatly reduce your taxable income to the tune of $75,000 to $80,000 per $100,000 invested. So let's get to the nitty gritty of those details, the good, the bad, the ugly, and let's make sure that we're having that conversation. So 630-492-1912, 630-492-1912. Set some time up with Paige. She will get with me and my calendar in a time that works for you, and let's just have an introductory call and allow us to educate you on some good tax planning strategies. So fear and greed. I don't know if you've seen the fear and greed indexes. There's many out there. When we look at a couple, obviously what's going on in the market, the S&P 500 is just, it's on track for its 9th consecutive green week, which would be its longest winning streak in 20 years. Think about that. 9th consecutive green week. It would be its longest winning streak in 20 years. So most of the fear and greed indexes that we are looking at, that we have followed, are in the extreme greed category. If there's one thing that's consistent, is we're going to see Wall Street repeat itself. We see over and over again people do really well in years like this year, and let's say we've seen some very, very big, well-credentialed strategists come out and say next year we're going to see limited to no growth. Some are even saying that we could see negative growth on the S&P to the tune of 10 to 20%. So yes, this year was great. This year's over. The challenge, the question that I want you to think about is, what is your advisor going to do to recoup, or not recoup yet, but keep these gains? What strategies do you have in place that when you see years like this, that you could now move those gains to a strategy that's going to be a little bit more predictable, a strategy that's going to build in a level of, we call it airbags or life vests, to, if the markets are negative, you actually can still make money on that, on those monies. What are you going to do? And those strategies hopefully are going to be implemented relatively soon, because the markets in January could become very volatile. We're going into an election year. It's anybody's guess. Now, a lot of people are thinking with what the Fed is doing, they are reducing taxes or reducing interest rates in a period of an election year. So what does that mean? Well, that means that we're probably, money and liquidity is going to become more prevalent. But we have to look at where we're at today. 75% of the S&P 500 stocks are trading above their 200-day moving average. That's just a fancy way of saying that things could be very expensive. So individual investors, financial advisors, they're always rear view mirror perfection investors. Does that even make sense? But basically, they're looking at what did well. Okay. It doesn't matter what did well. Hopefully you had a great year this year. I mean, you look at small caps, for example. Small caps in the last, 30 trading days, we've just seen massive growth. We had an overweight allocation to small caps this year. Small caps up until about 8 weeks ago had a very, very negative year. But you looked at the just the difference between the returns of the S&P versus small caps, and it was at historic levels. So you don't have to be a genius to say, well, you know what? Well, if everything's going to revert back to the mean, maybe we should overweight small caps. Maybe we should take from the mega cap gains, give to the small caps, right? Because generally speaking, if we look at history, we knew that a small cap move was probably going to take place. Now, it's been a lot greater than we envisioned. It's been a lot greater than probably most people envisioned, but it's not rocket science. It's just taking from the names that did really, really well, reallocating some of that money to names that didn't do really, so well this year. Well, those names have really ran back up. So not only did you make money on the large cap tech, you also made money now on this in the small cap space. I want you to think, what do you have inside of your portfolio that if we are in a sideways market, that you're going to still have positive returns, that you're going to still deliver growth? Because inflation's not going anywhere. Many people think inflation is actually going to spike this year. But again, statistics are what statistics are. We can always craft whatever message we, the advisors, want to send. If we want to send a fearful message, we can find the statistics that'll send that message. If we want to send, looking at everything through rose-colored glasses and the markets are only going to continue to go up, we can send that message as well. It's unfortunate, but the reality of a good advisor is one that can say, well, we don't know where the markets are going. When we look at the probability, if I just look at where the S&P is today and I look at where we think it's going to end in 2024, there's just not a lot of upside potentially, right? Now, that doesn't mean we get super conservative because, again, we want strategies that'll do well in all markets, right? But I want you to think about your portfolio today. And when it comes to the equities, and if you have mutual funds and you have over $100,000 in those mutual funds, we have to talk. Okay. We just have to talk. 630-492-1912. 630-492-1912. Again, we talked a lot about complexity. Complexity is not a bad thing, right? When it comes to the equity bucket, one of our strategies that we utilize just simply follows the market. It's trend following, where if they need to be offensive, they're going to be offensive. If they need to shelter, they're going to shelter. The problem with this industry is most advisors are going to always tell you why you can't play defense. You just have to sit and hold. It's okay to lose money. Don't worry about it, because if you need it, in 5 to 7 to 10 years, it's going to be higher. Okay. Is that really how you manage your money, Mr. or Mrs. Advisor? You just, take it as it comes. You don't actually try to play offense and play defense. That's not day trading. That's not trying to be speculative. That's not trying to time the market. That's just playing offense and defense. And we have a very complex strategy that we have access to that's their job. And they've been able to do it since 2000. Again, if you're going to judge winning and losing by getting out at the top and back in at the bottom, you're always going to be disappointed. But if we see a sideways to volatile market, we want a manager that can take advantage of the ups, protect from the downs to the greatest extent that they can. And then we're just stacking gains on top of gains on top of gains on top of gains. That's the job of an advisor. Problem is, most advisors don't do it. They're lazy. They have 100 clients, 300 clients. They manage 100 million to $1 billion, and their lives are good. Let me tell you, advisors, we make a lot of money. That's just the way the industry is. And unfortunately, people just stopped managing risk. And that's why you're on this constant roller coaster, the individual investor. And our job is, we're not that way. We're not going to be that way. We're going to never be that way. And that's something that we take very serious. So we went through a lot of stuff this week. It was all over the place, and I'm okay with that, because my job is everybody's driving around on a Saturday morning, or you're catching this on a podcast, and everybody's different. And I just want you to know that if you want to reduce your taxable income, we have strategies that can greatly reduce your taxable income. If you want strategies that can make money when the markets are down, we have those strategies as well. If you are a more nervous client and you want principal protection strategies and you're okay with 5 to 12% on the upside, those strategies exist as well. So those are the things that we're doing. Those are the things that make us unique. That is why individuals work with us. It's just really what we're bringing to the table is we're trying to take complexity and break it down into a way that you can understand it, because we're not any smarter than you. Whatever industry you're in, a very basic concept could be completely complex to me. It's just the same thing. We just deal with numbers. I've got 26 years on you of experience where I can see the good, the bad, and the ugly, and then I can hopefully craft a portfolio that can at least display characteristics that'll do well whether the markets are up, down, or sideways. So we're looking forward to a great 2024. We want to talk about tax reduction. We want to talk about returns or strategies that can do well when the markets are down. And we want to talk about ways to maximize your income. So that's our focus. If you have any questions or if you want to have a conversation, easiest way to do it is get with Paige. She'll set some time up for us to have a conversation. 630-492-1912. 630-492-1912. Talk to you soon.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.